Thank you very much for being here. It's great to see such a big audience in such a beautiful opera house, many young faces. Thank you very much. I will try to keep this as tight as possible. We don't have so much time and we have a lot to discuss. So I'm going to start straight away. Thank you, David, for joining me on stage. I wanted to start with some good news, which is that there is about $2.8 trillion worth of investment at the moment in so-called sustainable funds. So shares and bonds that have been bought because the companies that are included in these funds are considered sustainable. Now, the big question mark that has arisen is who decides that they are sustainable? And the term that we're using and hearing more and more is greenwashing, by which we mean are people saying that they're doing something that they're not really doing. And I think the question arises because it's a very big industry, obviously. We don't really have a system whereby the analysts are monitored. Private companies are making money out of the business of rating and deciding what is sustainable or not. And of course, the auditing is not the same as the classic auditing. We don't have a balance sheet. We have a much more arbitrary system of judging this. So my question is, what do you see as the potential to really regulate this? We have some initiatives. We have the European Commission is coming up in June with a proposal. The US is studying something, India also. But at the moment, would you agree that this is one big chaotic situation?
It certainly is chaotic, and I think the pushback that has come over the last couple of years, not just from those in the United States, but also those on the environmental activist side about greenwashing is not unfounded. I think there is a bit of a Wild West here, and what really needs to happen is, in the same way that financial statements are operating on a basis of acceptable standards, and then from there, there's still a lot of judgment that needs to be made about whether that suggests a company is going to be financially successful in the future. Sustainability needs to reach that point, and so I see the role of regulation being critical in making clear these definitions, in avoiding the potential self-interest. We always have to remember this oppositional relationship between, say, the analyst and the evaluated company, in the sense that that company really wants to look the best it can, and without any parameters on what they can and can't say, then you start to run into an issue where there's very little information value out there. And so the opportunity here with things like Europe's SFDR, with guidance from reporting requirements in the US, in the UK, and other parts of the world, begin to provide the analyst and provide the marketplace with the tapestry to begin evaluating those products.
And what do you think is the likelihood that we will have just parallel systems? In other words, that something that seems to require global regulation is actually going to end up being regulated in very different ways in different places?
So good news and bad news on that. The good news is, I think more than any other issue I've seen in my experience in the financial sector, there has been a discussion of interoperability and a need to focus on it. And even the IFRS Foundation, which is responsible for the International Sustainability Standards Board, has deemed it a IFRS agnostic framework. The goal is not based on what accounting standards you're under, but really that much of this work is designed to be interoperable. It's also designed to be focused on kind of concentric levels of obligation. If you're going to meet one commitment, then another jurisdiction won't have a conflicting commitment, but might have that plus something else. So that's the good news. The maybe less good news is that I think we have to talk about two-way interoperability. I think it's much easier to go from very specific rules, such as what Europe is putting forth with its just approved ESRS, the sustainability reporting standards, and a more principles-based approach. I think it's much easier to go and comply with a principles-based approach. I think for jurisdictions that start with that principles-based approach, going to a more legalistic and individual article line item element is going to be a little bit harder. And so that, to me, is where I would keep my eye on the concerns around interoperability.
And what happens, you think, in terms of enforcement? In other words, two things. First, if the rules are tighter, do you think the industry itself will get smaller? In other words, part of the enthusiasm at the moment is that you can set up a fund, a sustainable fund, without a lot of monitoring, essentially. You can say, I am a sustainable fund. You think once the rules will get tighter, will there be just a smaller industry? And in a way, this will then become a sort of vicious circle. The tighter the rules, the less money goes into actually financing companies that are trying to fight climate change.
So I would say yes and no. The first is that I think you can have, yes, a smaller number of notional dollars, euro, pounds, whatever you like, going into funds that are deemed to be green, sustainable, if the standards rise and some of those things get cut off. But that, I think, is a good thing, and that is probably a natural order of things. What I would say, though, is that we can have different classes of sustainability. In the European Union, we have Article 9, the kind of bright green, and Article 8, and then Article 6 with different levels of what they are spelling out and requiring. What I would say, though, is I don't think that the demand is dampened at all. And this is why people created these funds to begin with. Why is it desirable to have a sustainable fund? Well, because there's a large group of individuals in the marketplace who want to see their money going toward constructive purposes, because there's also these really strong tailwinds. And so I do see demand continuing to rise. I do see the market-driven transition also rising that demand. So I think near term, you'll see smaller absolute numbers, but I think it's not going to actually dampen the growth or the access to capital of firms that are really doing things that have impact. It'll just make it easier to spot those and not see them mixed in as kind of a diamond in the rough, as it were, of a mixture of non-sustainable and sustainable activities all under one header.
Okay. We are seeing, of course, in response to this fear of greenwashing, a new wave of activism. Last month, for example, in New York, outside the New York branch of the Federal Reserve, there was a huge protest. We are also seeing some lawsuits. A French bank that is in no way as brilliant as our sponsor, BRD, Société Générale, but BNP Paribas got sued earlier this year for financing oil companies and others in France. What do you think is going to be the strongest push? Is it going to be the bottom-up and the sort of legal action taken by activists and foundations, or is it going to be the leadership from the top? Which way are we going to be able to sort out the greenwashing problem first?
I really think it's just like broader sustainability, it really is an all-hands-on-deck effort. And I talk about the ecosystem approach, that we can't really think bilaterally about activists naming and shaming and a company and say, how effective is that? We have to consider it in the ecosystem of what laws are in place, how are market actors responding. And so I think that the activist community has really increased the level of understanding that the average consumer has and that the average lawmaker has around what is a credible commitment. I joke sometimes that 10 years ago, being sustainable was having a picture of your employees planting trees somewhere, whereas 5 years ago, it was buying offsets for flights. And so I think that what we're seeing is really working from both ends, and they do reinforce each other in a lot of ways.
Okay. What about, what is your feeling in terms of enforcement? For example, I have the feeling that every year we have a conference, a COP, and so on, repeating pretty much the messages about things that we know. We know what we have to do by 2050. It feels a little bit like the fight against smoking, where we have accepted that there is such a thing as lung cancer, yet Philip Morris, for example, is making very good money as we speak, despite of this. So what do you think is the enforcement tool, the stick, that is really going to work? Is it going to be the taxation, or is it going to be the exclusion of companies, for example, from certain funds, like the obligation not to have them in your funds? Which way is going to be more effective, you think?
I think it's going to be a few things, and depending on the industry, it will differ. I think the cross-border adjustment mechanism that will really kick into place within the EU will be a powerful driver. I think it will motivate trade partners as well. It is sort of the next best thing to a carbon price in terms of changing that dynamic. I think the market itself is changing these decisions when it comes to the level of renewable capacity being installed and the economics there. But ultimately, I think it's going to have to be a mixture of policy-driven decisions, things like Fit for 55, the Inflation Reduction Act, getting these things to scale, but then rules to really make sure that people have the right information. Otherwise, we're not going to see as efficient allocation of capital as we need, and that's why the guidance we talked about earlier, these standards are so critical.
I wanted to ask you, I heard you say once that it's not the same for Belgium and Bangladesh to go to carbon neutrality. The cost, the challenges are different. What happens for the countries of this region, Central and Eastern Europe? I live in Poland. Poland is voted against the Green Deal of the EU, is very unhappy about the ETS system, says it doesn't work at all, and it also feels that the cost that it has as a former communist state that relied on heavy industry, coal, and so on, is not taken into account. I imagine Romania probably has a similar discourse. These countries essentially are trapped between the fact that they are already in a very advanced regulatory system, which is a one-size-fits-all model of the EU, but they believe that they are not taken, their specific issues are not taken properly into account. What do you see as the room for these concerns to be solved, and who should solve them? Is it the finance institutions that should give a lot more money to places that are in this difficult transition, or is it, you think, at the higher level, the governments and perhaps the EU that should make special exemptions for such countries?
Yeah, I think that this really gets to the heart of the idea of the just transition, and recognizing that if we're not going to go all together on this journey, we're not going to get there. And we saw that with the pushback in France, with the Yellow Vest protests that largely had been driven by an increase in the tax of petrol. We see that in a lot of those that are most ardently supporting the anti-ESG movement in the US. You look at many of the states there that are doing that. And I think the point of this is it can't be one size fits all, and yet at the same time, the science tells us that we need to act and we need to move. And so the only real decision, I think, is to really appreciate that this can't mean those that have made sacrifices, those that have had the hardest time getting to where they are now, need to shoulder an excess of the burden. If anything, this is where policy from the top down needs to make these things right. And I think there are two ways to do that. One is through the exemption approach, which I think is sort of the quick fix and the short way of continuing the status quo, but it's kind of driving a car closer and closer to a cliff. Ultimately, I think you want to get any area, this region in particular, down in terms of emissions, and that really means that there needs to be support for that transition, and active support that doesn't leave people behind.
What about the issue of essentially the big gap in the financing mechanisms? So you've mentioned, and it's clear, for the same project, different finance institutions might offer credit with a huge spread, maybe even 1,000 basis points. So what does that mean? Because we have then the possibility to shop around. A highly polluting project can just look for very cheap financing elsewhere if it doesn't get what it wants from a stricter financier. Are we going to be able to avoid that, or is it going to be the case that there'll always be loopholes, access to money from somewhere else, maybe even from other parts of the world?
I think there's always the potential for some degree of leakage. I think most of the studies have shown, though, that access to capital has direct impacts on the cost of capital. What I would say is a lot of the challenge actually is more on the renewable energy side and on scaling up green infrastructure, especially in emerging economies, where data isn't very good, where models don't really exist, and so you just have massively inefficient markets. So driving away some of that inefficiency lowers the cost of these projects, gets more of them built. On the other side, on the fossil fuel side, what I would say is that we're also in a different situation than we were, say, 15 years ago. The capital markets have gotten so big, and especially the last year plus post the Russian invasion, you've seen such a cash hoard and such a windfall for these companies. So many banks that would do traditional financing are no longer the most interesting financial partners for many fossil fuel companies. And so one of the challenges here is thinking about how does the market move away from these things when there's a high capacity right now to self-finance. And I think that is another place where regulation becomes so important, because doing this by the time the market will take action will probably be too late for climate.
We now have crude oil. Of course, we have special circumstances. We have a war in Israel, but still, we have crude oil basically back at around $100 a barrel. What does that tell us about how the finance of our world has shifted, or not at all, away from fossil fuel production?
So I think oil is a challenging one because it is so enmeshed in the global economy, from petrochemicals, of course, to it being one of the most important global commodities. It's hard to really see much of a dampening in overall oil demand over the last few years. What we're kind of seeing is that the renewable energy is floating on a sea of fossil fuels right now. I would say the story is different for coal, which in many countries is now becoming economically unviable. The challenge will be with oil, really, how do we avoid the lock-in? Same with gas, of how do we avoid the lock-in? We know that in the next several years, oil demand will be fairly consistent. Even in many of our net zero pathways, it may fall slightly. But what we can also see is sometimes small drops in demand have very big price effects. And we see this, of course, with oil because of the storage costs, because of the need. We saw this back in 2020 when futures briefly went negative. And so I think right now we're seeing less of an effect about the broad transition and more of a near-term geopolitical volatility that is pushing prices where they are.
And what is AI going to be doing to the financing of environmental projects? Is it something that is at the moment already there, or is it everywhere except in this field?
So it does seem like AI is everywhere, and AI is a bit of that iceberg of once it reaches public consciousness, you know that 9/10 of it is already below the surface that has been going on for years and years. I would say AI makes a million little differences, many of which haven't yet been implemented. There isn't a sort of killer app, but there is a better allocation of electricity, and so we can better manage surges, which may mean we need less baseload power. It can mean for a solar farm that they can know the precise angle that the sun is coming to maximize generation. It can be for materials to know what is the right mixture in materials science to produce something with a lower carbon. But each of these is a tiny chipping away, and I think it is really about process improvements. People looking for the 90 or 95% solution from AI, I think, will be disappointed. It's going to be 1,000 small incremental solutions, but they will add up, I think, to massive change.
Well, thank you very much. I'm Swiss. I believe in punctuality. This has been very, very insightful and interesting for me. Thank you very much, David. I hope you've also benefited from it, and thank you for listening. Thank you very much.